Hello and welcome to Money Maximized. Today, you will talk about simple ways to save money. Sometimes the hardest thing about saving money is just getting started. This step-by-step guide can help you develop a simple and realistic strategy so that you can save for all your short and long-term goals. Number 1. Record your expenses. The first step to start saving money is figuring out how much you spend. Keep track of all your expenses. That means at every coffee, household item, and cash tip, as well as regular monthly bills. Record your expenses, however, is easiest for you a pencil and paper, a simple spreadsheet, or a free online spending tracker or app. Once you have your data, organize the numbers by categories, such as gas, groceries, and mortgage, and total each amount. Use your credit card and bank statements to make sure you've included everything. Number 2. Include saving in your budget. Now that you know what you spend in a month, you can begin to create a budget. Your budget should show what your expenses are relative to your income, so that you can plan your spending and limit overspending. Be sure to factor in expenses that occur regularly, but not every month, such as car maintenance. Include a savings category, your budget, and aim to save an amount that initially feels comfortable to you. Plan on eventually increasing your savings by up to 15 to 20% of your income. Number 3. Find ways to cut spending. If you can't save as much as you'd like, it might be time to cut back on expenses. Identify non-essentials, such as entertainment and dining out, that you can spend less on. Look for ways to save on your fixed monthly expenses, such as your car insurance or cell phone plan, as well. Other ideas for trimming everyday expenses include: search for free activities. Use resources, such as community event listings, to find free or low-cost entertainment. Review recurring charges. Cancel subscriptions and memberships you don't use, especially if they renew automatically. Examine the cost of eating out versus cooking at home. Plan to eat most of your meals at home. And research local restaurant deals for nights that you want to treat yourself. Wait before you buy. When tempted by a non-essential purchase, wait a few days. You may realize the item was something you wanted rather than needed, and you can develop a plan to save for it. Number 4. Set savings goals. One of the best ways to save money is to set a goal. Start by thinking about what you might want to save for, both in the short term, 1 to 3 years, and the long term, 4 or more years. Then estimate how much money you'll need and how long it might take you to save it. Number 5. Determine your financial priorities. After your expenses and income, your goals are likely to have the biggest impact on how you allocate your savings. For example, if you know you're going to need to replace your car in the near future, you could start putting away money for one now. But be sure to remember long-term goals. It's important that planning for retirement doesn't take a backseat to shorter-term needs. Learning how to prioritize your savings goals can give you a clear idea of how to allocate your savings. Number 6. Pick the right tools. There are many savings and investment accounts suitable for short and long-term goals, and you don't have to pick just one. Look carefully at all the options and consider balance minimums, fees, interest rates, risk, and how soon you'll need the money, so you can choose the mix that will help you best save for your goals. Number 7. Make saving automatic. Almost all banks offer automated transfers between your checking and savings accounts. You can choose when, how much, and where to transfer money, or even split your direct deposit so that a portion of every paycheck goes directly into your savings account. The advantage: you don't have to think about it, and you're less likely to spend the money instead. Other easy savings tools include credit card rewards and spare change programs, which round up transactions to the nearest dollar and transfer the difference into a savings or investment account. Number 8. Watch your savings grow. Review your budget and check your progress every month. That will help you not only stick to your personal savings plan, but also identify and fix problems quickly. Understanding how to save money may even inspire you to find more ways to save and hit your goals faster. Remember that securities are not insured by the FDIC, are not deposits or other obligations of a bank, and are not guaranteed by a bank. They are subject to investment risks, including the possible loss of your principal. Now, the only thing left here is how to be financially fit when you're young. Checking in on your financial status might seem like something that can wait, but routinely assessing where you stand can benefit you today and down the road. Here are steps to consider. Understand your assets and liabilities. The assets you own and the debts or liabilities you have determine your net worth. Assets might include cash, savings, stocks, bonds, retirement accounts, real estate, and anything else of value, such as cars or collectibles. Liabilities might include a mortgage, student loans, auto loans, bills due, and credit card debt. Consider calculating your net worth annually by adding the value of all your assets and subtracting your liabilities. This can help you keep tabs on your overall financial picture. Tip: if you're just out of college and have a lot of student loan debt, you may have a negative net worth. That's not necessarily bad. It just means you have some work to do. Assess your goals once a year. Think about your short, medium, and long-term goals. Are each still relevant? How much do they cost? Are you on track to meet them? Some long-term goals, such as traveling and retirement, may not change substantially year to year. Short-term goals, such as paying off a credit card bill, and medium-term goals, including saving for a house, may change more frequently. You might decide to reevaluate those every 3 to 6 months. Check your credit reports. Your credit report contains information about the status of your credit accounts and your bill-paying history. A good credit score is critical to qualifying for loans at the best possible rates. The Consumer Financial Protection Bureau (CFPB) recommends checking your report at least once a year to make sure it is up to date and correct. Plus, the CFPB suggests an extra check before applying for loans for big purchases like cars and houses. There are 3 major credit reporting agencies: Experian, Equifax, and TransUnion. You can ask for a free credit report from each of them every 12 months. Name your beneficiaries. When you open a retirement account or buy an insurance policy, you'll probably be asked to name a beneficiary, the person who would collect from the account. In the event of your death, marriage, the birth of children, divorce, and death can affect your choice. Typically, your spouse is your default beneficiary, but you also may wish to designate children or someone else. Though designations likely will not change often, it's still a good idea to check your elections yearly to make sure they're still appropriate. Manage your taxes. It's important to make sure you have enough set aside to pay your tax bill well before the annual deadline, generally April 15th. The amount of federal income tax you owe each year depends in part on your tax bracket, but many factors affect your ultimate federal tax liability. Learn more about income tax brackets. In most cases, your employer withholds taxes from your paycheck, although the amount withheld will often differ from what you ultimately owe. If you are self-employed, however, you will likely need to pay an estimated amount of tax instead, usually on a quarterly basis. Failure to make estimated tax payments when required may result in penalties. Each fall, when you still have time to make adjustments before year-end, consider checking the amount you've set aside for taxes against last year's tax forms. Check if your investment and goals align. It is likely your investments, whether in retirement plans or taxable brokerage accounts, consist of mutual funds that hold various kinds of investments. Consider checking quarterly, in January, April, July, and October, to make sure your selections are appropriate for your age and financial goals. Determine if you have the right insurance. About once a year, it's important to assess the type and amount of insurance you need. If you rent your home, you may want to consider renter's insurance to protect your belongings. When you buy a home, you need homeowner's insurance. Your policy should cover what it would cost you to rebuild your home, which is often more than your home's face value, as well as the current price of replacing your household items. You also may want special coverage for valuable items such as jewelry or artwork. Your insurance agent can help you assess whether you have the right type and amount of coverage. If you have dependents, you may wish to consider life insurance, which, in the event of your death, would pay them cash to help make up for the loss of your income. You might also consider disability insurance to replace a portion of your income in case you become ill or are injured and unable to work. Individuals who are financially healthy are able to manage their day-to-day expenses, absorb financial shocks, and progress toward meeting their long-term financial goals. Approximately 2/3 of people in America are classified as financially coping, struggling with some aspects of their financial lives, or financially vulnerable, struggling with almost all aspects of their financial lives. Congratulations! By following these steps and committing to improving your financial health, you're well on your way to achieving financial freedom and creating a secure future for yourself. As we all know about the popular saying, health is wealth, however, very few people know its real meaning. The true meaning of this proverb is good health of any person is the real wealth of him, and not money. If we maintain our health, it would be stable and remain with us in future. However, money never remains stable. Good health brings satisfaction in people's mind, whereas money brings greediness and insecurity. Being healthy does not mean the absence of physical troubles in the body only, but it means to be healthy in terms of physical, mental and social well-being. If one loses health, she loses happiness also. According to the Mahatma Gandhi, it is health which is real wealth, and not pieces of gold and silver. So, good health is more important than wealth. Building good health requires natural light, fresh air, clean water, clean environment, balanced diet, daily exercises, good job, peaceful family environment, etc. Clean environment without pollution helps in improving immune system and overall health. Remember, building financial health is a journey, so stay disciplined, stay focused, and keep learning. Thank you for watching, and we'll see you in the next video. So, don't forget to hit the like, subscribe, comment, and share.